Hello, everyone. Welcome to GRC in Focus, a podcast dedicated to startups and emerging fund managers. I'm your host, Asad Bukhory. I bring 20 years experience helping TCSPs and global fund managers build GRC frameworks. I've overseen compliance, operations, and distributions, and I've also sat on boards. So my goal here is to leverage that multifaceted experience and support fund managers. So whether you're spinning up Fund 1 or you're scaling Fund 2 or 3, I hope that this podcast will help you turn regulatory complexities into a competitive edge. In today's debut episode, I will try to unpack the challenges that the democratization of private markets presents to startups and emerging managers. And I'll also try to look at how they can position themselves to capitalize on this opportunity without tripping. So let's dive in. There's a key trend reshaping the investment landscape right now, and that's the democratization of private markets. Everyday investors are starting to gain unprecedented access to opportunities in private markets, opportunities that were once the exclusive playground of institutions and the ultra-wealthy. Now, for decades, if you've wanted to invest in private equity or private credit or other alternative assets, you probably needed millions of dollars and the right connections. But that's changing, and that's changing fast. Deutsche Bank has partnered with Color Capital to offer a secondary private equity fund with just a 50,000 euros minimum investment that's available to high net worth individuals in Europe and in Asia. Similarly, Vista Equity Partners has just launched Vista One with a $25,000 minimums for non-US investors with quarterly liquidity. So you can see the barrier for retail investors has dropped from millions to mere thousands. So as I tried to make sense of what that means for the industry, I asked myself, is this going to open the floodgates? Because let's be honest, these aren't just experiments that are being conducted in a vacuum. These are very strategic, very well thought initiatives by some of the largest wealth managers, distribution giants, who are betting on the future of retail private markets. And I think we are witnessing what I call the post-minimum world, where the size of your investment is no longer the primary gatekeeper to private markets. We are starting to see sophisticated new structures. We are seeing regulatory frameworks and operational infrastructures that are opening the doors to retail investors. Now, let me help you understand the magnitude of this transformation. According to a report by Deloitte that was released in April, currently retail investors in the US have about $80 billion allocated to private capital. But by 2030, this figure is projected to reach $2.4 trillion. You heard that right. We're talking about a 30-fold increase in just a few years. And in Europe, the story is equally compelling. The new LTIF 2.0 framework, that's the European Long-Term Investment Fund regulation, is expected to attract over 100 billion euros over the next 5 years. Now, globally, private market assets under management have reached tens of trillions of dollars. So I think retail investors are looking at this and they're probably salivating and they're going, well, wouldn't it not be nice for us to be able to have a piece of this pie? Now, you're probably thinking, but why now? And what's really driving this seismic shift? I think there are a number of converging forces at play here. What I think is happening, firstly, we've had years of persistently low yields in public markets. Traditional fixed income investments, the bedrock of many retail portfolios, they've offered paltry returns. And so I think this has created a powerful incentive for investors to seek alternative sources of yield and return, with private markets offering the potential for higher, albeit less liquid returns. Now, for an emerging manager who's looking to bring, let's say, private equity or private debt strategy to retail investors, the recent shifts in capital markets are instructive. After years of near zero rates, the era of free money is decidedly over. While the Fed has initiated some rate cuts in 2024, I think overall the cost of capital is still quite elevated. What does this mean for managers? If we're talking deal flow in private equity, the companies that you're looking to invest in, they are facing more scrutiny, and they need to demonstrate clearer path to profitability and robust operational discipline. Secondly, this might mean a more challenging sourcing environment, but also potentially higher quality, more resilient underlying assets for your retail funds. For your private debt strategies, I think the same discipline imposed on companies can mean more credit-worthy borrowers, but also a greater need for flexible, tailored lending solutions that perhaps banks might be slower to provide. So clearly, there's a gap here for emerging managers to step in and to fill. Now, crucially for your retail investors, this underscores the importance of educating them that the high-flying returns that we've seen during the quantitative easing era, these are not the norms. Your value proposition will increasingly need to center on sophisticated asset selection, value creation in private equity, or a strong risk-adjusted yield in private debt within this more, dare I say, demanding economic landscape. Secondly, you have technology. Technology has been this massive enabler in that it has dramatically lowered the operational barriers that once made serving thousands of small investors prohibitively expensive. Digital onboarding, automated compliance systems, and sophisticated data analytics platforms are now making it economically feasible to offer these products to a broader investor base. And then thirdly, and this is crucial, I think we are seeing a shift. We're seeing a shift in regulatory philosophy on both sides of the Atlantic. Regulators are increasingly recognizing that excluding retail investors from private markets may actually increase systemic inequality by denying them access to potentially higher returning asset classes. And so I think this has led to some of the reforms that we've seen designed to facilitate retail access while maintaining appropriate investor protections. But there's something else that I think is being overlooked. That's the changing dynamics of public markets. When you look at the number of US public companies in the mid-90s, we've gone from 7,300 public companies to roughly 4,800 in 2021. Meanwhile, private equity-backed firms have grown fivefold over the past 20 years. But perhaps even more importantly, this phenomenon of companies staying private longer is frankly a cornerstone of the opportunity for emerging managers in the retail private equity space. High-profile decisions like Stripe remaining private, I think, reinforces this. So for emerging managers bringing private equity to retail, this is your narrative. You're offering retail investors access to the primary growth phase of innovative companies. Value creation that largely happens before any potential, often much later IPO. You are bridging a crucial gap. Now, for those of you who are targeting private debt, the backlog of mature, late-stage private companies that are not yet ready or willing to IPO creates significant demand for alternative financing. These companies, they still need capital for growth, for acquisitions, or shareholder liquidity. And so this is a prime opportunity for private credit funds, including those you are aiming to offer to retail investors to step in as key capital providers. Now, If retail investors can't access these private market opportunities, they are essentially locked out of participating in the growth stories of many of the economy's most dynamic companies. Now, as an emerging manager, you probably need to consider thematic opportunities. And I think artificial intelligence right now could very well be one of those. Some investors have even dubbed last year as a Sputnik moment for AI, with a reported $150 billion in venture investment. So if you're targeting private equity opportunities with an AI focus, I think your challenge right now as an emerging manager is to cut through the hype and identify genuine, sustainable value for your retail investors. The scale of investment is immense, but I think so is the need for rigorous due diligence. I think there's also interesting pockets within AI for private debt managers. So think data centers, specialized chip manufacturing, and infrastructure. I think these present significant private debt opportunities because these are tangible assets or projects that can be underwritten, potentially offering attractive risk-return profiles for retail-focused credit funds. But even if AI is not your direct investment focus, the operational efficiencies that AI can bring to your own fund management business, I think from a GRC to retail investor onboarding and servicing, are worth considering. As an emerging manager, you need to optimize and streamline your operations, and you need to scale efficiently. If you are an emerging manager targeting retail, understanding how to reach and build trust with this audience is very important. Now, if you look at the media landscape, particularly the rise of new media and the creator economy, you can see traditional channels are being disrupted. And so this means you need to think about how to strategically build your brand and communicate your unique value proposition directly, but authentically. You need to think how you can leverage new channels to educate retail investors about the complexities and the benefits of private equity and private debt, but in a compliant way. Building that social capital and that credibility, I think, is critical when you're an investor, is an individual. Now, let's talk about the regulatory revolution. In Europe, LTIF 2.0 has reimagined how retail investors can access private markets. The original LTIF regulation that was introduced in 2015, I think it was well-intentioned, but it was largely unsuccessful due to overly restrictive rules. LTIF 2.0, which kicked in, I think, in January last year, has addressed most of those shortcomings, and dare I say, comprehensively. Now, the scope of eligible assets has been dramatically expanded. LTIFs can now invest in equity or quasi-equity in qualifying portfolio undertakings. This includes listed SMEs with market capitalization up to 1.5 billion euros, 3 times more than the previous limit. They can also invest in real assets with no minimum value requirement, so removing the previous 10 million euro threshold. Critically, they can now invest in other funds, including UCITS, and so enabling fund-of-fund structures that could be particularly valuable for emerging managers who are seeking retail distribution. But worth noting that retail marketed LTIFs have a specific concentration limits. So no more than 20% in instrument from a single undertaking, no more than 20% in a single real asset, and no more than 20% in units of a single underlying fund. But the minimum investment threshold has been completely removed. This now allows managers to basically set appropriate minimums based on their strategies. But here's where I think it gets really interesting. The liquidity provisions. While LTIFs are fundamentally long-term vehicles, LTIF 2.0 allows for redemptions during the fund's life under specific conditions. ISMA's regulatory technical standards, which entered into force in October last year, It provides detailed frameworks for how these redemptions should work. Basically, managers must calibrate redemption frequency and notice periods based on the fund's liquidity profile using models outlined in the RTS annexes. They can also employ various liquidity management tools, including redemption gates, notice periods, and anti-dilution levies. Importantly, the European Commission clarified that LTIFs cannot apply different redemption terms for different share classes. Now, I think this is important. This is important because it ensures fair treatment across all investors. In the US, the approach has been different, but I think equally innovative. Rather than creating new vehicles, the US has leveraged existing structures under the 1940 Act, specifically interval funds and tender offer funds. Now, interval funds, they operate under Rule 23C. They must make periodic repurchase offers to shareholders, so typically quarterly, semi-annually, and annually. They must offer to repurchase anywhere between 5% to 25% of outstanding shares at NAV during each interval. The rules are precise, so shareholders must be notified 21 to 42 days before the repurchase request deadline. And payment must be made within 7 days after the pricing date. Importantly, interval funds must maintain liquid securities equal to at least 100% of the repurchase offer amount from the time the notice is sent until the pricing date. So this creates a structural liquidity buffer. But unfortunately, I think this also introduces a cash drag. And then you have tender offer funds. These operate under Exchange Act Rule 13E, and they have more flexibility. They make repurchase offers at the manager's discretion, so there's no mandated frequency or amount. Most tend to make quarterly offers, but they're not required to. They also don't have specific portfolio liquidity requirements during the tender offer period. And so this gives them more investment flexibility. But I think the real breakthrough in the US was last month. I think that's perhaps the most significant regulatory development for retail private market access in decades. For the past 23 years, the SEC staff had maintained an informal policy that closed-ended funds investing more than 15% of their net assets in private funds should limit their investors to accredited investors and require minimum investments of $25,000. Last month, SEC Chairman Paul Atkins announced his plan to urge the SEC to reconsider the position that it had held for the past 23 years. He expressed concerns that such blanket requirements unnecessarily stifle innovation and block retail investor access to hedge funds and private equity funds. The very next day, Division of Investment Management Director Natasha Grainer confirmed the SEC would no longer enforce the 15% limit during registration reviews. Now, I see this as a shift in regulatory philosophy. I think this is basically the SEC acknowledging that the private market landscape has evolved since 2002 and that retail investors deserve access to these opportunities within the protective framework of the 1940 Act. Now, with these regulatory shifts opening doors, let's talk about your choices as a UK-based emerging managers looking to offer private equity and private debt to retail investors. And let's say you want to offer a $50,000 minimum. Your jurisdiction and your fund structure are very important. They will impact your distribution, your cost, and your investor appeal. So here's how you can be strategic. Obviously, this is not legal or financial advice. You should consult with your own counsel. I think if you're looking at UK investors, the LTAF is your go-to structure. It's FCA regulated. It's designed for retail and institutional investors, like, for example, defined contribution pensions. And it supports private equity and private debt. So it can be open-ended, but with restricted redemptions. So, for example, quarterly with a 90-day notice. Or it can be closed-ended. So basically, it fits both strategies. To give you an example, let's say, a private debt LTAF that could invest 70% in UK SME direct lending, so blending senior loans with mezzanine debt. Now, it works because it offers marketing to advised retail, discretionary clients, or direct retail, but with a 10% portfolio cap. The $50,000 minimum is also accessible, and FCA oversight aligns with your UK base. If you are targeting European retail investors, then I think LTIF 2.0 or a Luxembourg CCAV would be ideal because they offer AIFMD passporting for cross-border distribution. LTIF support both private equity and private debt, open-ended or closed-ended, with a $50,000 minimum. It's retail friendly and tax neutral in Luxembourg, but you will need an EU AFM. So, for example, a Luxembourg-based AFM for passporting. Now, with CCAVs, they are flexible for both strategies. They are widely recognized, and they also support low minimums, but they also require an EU AFM. Now, if you are eyeing, let's say, US investors, I would say you could look at a Delaware LP or an interval fund could work. Now, you also have offshore options, like, for example, Guernsey and Jersey. For Guernsey specifically, you're looking at authorized funds that are retail focused, that support open-ended and closed-ended structures. Or you can look at the Guernsey registered funds. These are lighter touch and marketed via private placement to advised retail. Both support $50,000 minimums. Or you could look at Jersey structure. You would typically be looking at an expert fund. This would suit advised retail with a $50,000 minimum via wealth platforms. You could also look at unclassified funds. These are fully retail focused. They both support private equity and private debt, whether that's open-ended or closed-ended. Now, for broader distribution, you could potentially look at master feeder structure. Now, that's quite technical, so I'll probably do an episode on that later in the future. Let's talk about distribution. For emerging managers, I think a phased and diversified distribution strategy often works best. I think you shouldn't put all your eggs in one basket. White label solutions, I think, can be very attractive because two reasons. Firstly, speed to market. And then secondly, I think it allows you to keep cost low, especially when you're starting out. You should explore partnering with robo-advisors, but you must ensure that their suitability algorithms truly align with your product's risk profile. That alignment is very important. Now, if you are looking at, let's say, high net worth individual segment, you would need a more bespoke approach. Typically, that's through private banks or specialist wealth managers. But you need to be prepared because this requires dedicated relationship management. Now, let's switch gears and let's talk about some of the challenges. What does it take operationally to serve retail investors in private markets? When you're dealing with institutional investors, you might have 20, maybe 30 large, sophisticated clients. And they probably have teams of analysts who understand complex terms and, they, let's be honest, rarely need any hand-holding. But when you move to retail investors, you're potentially serving hundreds, if not thousands of individual investors, each with small investments, but often greater servicing needs. And so I'm afraid minor tweaks to your existing GRC and operational setup won't cut it. We're talking a quantum leap in the level of complexity. And your GRC and operational frameworks, they will need to keep up. Let me help you understand some of the main challenges. First, you need to think about the technology stack required for retail distribution. These are quite different from institutional infrastructure. You need systems that can handle high volume and high frequency transactions. So think daily NAV calculations compared to quarterly valuations that are more common in institutional funds. Now, this is particularly challenging when you're dealing with illiquid private assets because they typically don't have readily available market prices. You also need sophisticated CRM systems to manage thousands of investor relationships. You need automated compliance for monitoring to ensure ongoing suitability. And you most likely will need some form of digital portals that provide intuitive access to account information, to performance data, and transaction capabilities. Now, all of this needs to be mobile optimized because retail investors expect to manage their investments from their phones. The compliance burden for retail funds is also higher than for institutional vehicles. For registered funds, you need a board with a majority of independent directors, people with the expertise to oversee complex private market strategies and the independence to protect investor interests. You will need a dedicated chief compliance officer with direct reporting to the board, but also the resources to implement comprehensive compliance programs. You also need to think about your documentation, record keeping, because these are not light touch either. If you think about the sheer amount of suitability assessment, you will also need to ensure that your prospectus is comprehensive so that retail investors can understand them. With LTIFs, you need, your PRIPs and your KIDs. So these are standardized documents that show cost, risk, and potential returns. Your marketing materials will need to be fair, will need to be balanced, and they will need to have clear risk warnings. Now, you also need to think about liquidity management. This is perhaps the most complex operational challenge. Frankly, I think liquidity risk is something that should be top of agenda, particularly for retail funds. The board must be confident that management has robust and tested plans in place. Legally, your disclosures around liquidity mechanisms, especially under frameworks like, for example, LTIF 2.0 or LTAF, these need to be watertight. Any ambiguity here can lead to serious regulatory issues and investor complaints down the line. Now, when you're running a semi-liquid retail fund, you need to balance competing demands. On one hand, you need to provide enough liquidity to meet redemption requests. On the other hand, you need to maintain sufficient exposure to illiquid assets to generate the returns that investors expect. Now, for interval funds, this means maintaining the 100% liquidity buffer during repurchase periods. And for LTIFs with redemption features, this means sophisticated modeling of potential redemption scenarios and maintaining appropriate buffers. But every dollar that's held in liquid assets is a dollar not invested in higher returning private assets that are basically the fund's raison d'etre. So managers will need to develop sophisticated liquidity risk management frameworks. They need to come up with stress testing under various redemption scenarios and market conditions. They also need early warning indicators, warning systems to identify potential liquidity crunches before these become critical. And they also need clear policies on how to handle situations where redemption requests exceed available liquidity. Now, let's talk about your investor servicing and investor education. The demands of retail investors are very different from institutional clients. You need capabilities to handle potentially hundreds of inquiries about everything from basic account questions to queries about the fund strategy and the fund's performance. Response time will also matter here. Retail investors expect quick answers, as does the regulator. And so this ties into the UK consumer duty requirements. ensuring good outcomes for retail customers, which is mandatory. Now, this is a topic for the whole episode, but it underpins everything in the retail space. But beyond basic servicing, there's also the education aspect. Retail investors will need help understanding key concepts that institutional investors typically take for granted. For example, J-curves, capital calls, NAV calculations, carried interest. They will also need to understand why their private equity investment might show negative returns in its early years. And this education is not a one-time event at onboarding only. It's an ongoing process throughout the investment lifecycle. And during market downturns, when public markets are providing daily price signals of distress, while private fund NAVs remain relatively stable due to valuation lags, investors will need clear communication about what's really happening with investments. Getting your product to market and managing the economics are make or break for emerging managers. So let's talk about the economics. The cost structures are different from traditional institutional funds. So it's important that managers and investors understand these differences. I'll start with management fees. As we've touched upon, the US interval and tender offer funds that are available to accredited investors, these typically range anywhere between 1 to 2% of NAV. For European LTIFs, I would say somewhat similar. So average management fees for retail share classes are usually around 1.9%, with private equity LTIFs maybe averaging 2%. Private debt LTIFs usually around 1.5%. But then you need to add performance fees or carried interest, typically between 10 to 20%, above the hurdle rate, say 6, 7, 8%. So far, this might not sound too different from institutional funds. But then you have all the additional layers. If we are talking a UK LTAF, I would say we're probably looking around 300,000. For a US interval fund, easily above $500,000. If you're looking at a Cayman SPC, I would say segregated portfolio company, probably around $120,000. And then you have your ongoing fees, often expressed as the total expense ratio. For a UK LTAF, total expense ratio can range anywhere from 1.8 to 2.5%. US interval funds, we are looking at anywhere between 2.9 to 3.7%. For a Cayman segregated portfolio company, probably around 1.5%. Fund administration costs for retail funds are typically higher, mainly because of the volume of investors. Where an institutional fund might pay 5 to 10 basis points for administration, retail funds typically pay more. And then you have transfer agent fees. These are almost non-existent for institutional funds due to the simplicity of managing a few large accounts. But these can add up significantly for retail funds, again, because of the significant complexity and resources that are required to manage thousands of individual investor accounts. And then you have custody fees, you have audit fees, you have legal fees. All of these tend to be higher for registered retail funds, again, due to the more stringent regulatory requirements. You also have compliance costs, so your chief compliance officer, your compliance technology, your regulatory filings. These don't come cheap either. And then you have to think about your distribution costs, so platform fees, broker-dealer commissions, and trail fees. Now, some platforms charge upfront fees, ongoing basis point fees on assets, or they take a share of management and performance fees. So negotiating tiered revenue share models, I think, can be key here. For example, platforms taking 15 to 25 basis points on the first, let's say 50 million AUM, with that percentage then decreasing as assets scale, which can help preserve your economics. But when you add it all up, total expense ratios for retail private funds, these often land between 2% and 4%, and sometimes even higher. If you look at, for example, Vista Equity Partners, Vista One Interval Fund, for example, they quote annual cost ranging from 2.9% to 4.7%, depending on share class and exit timing. But beyond the explicit fees, there's also the implicit cost of maintaining liquidity, the cash drag that I mentioned before. A fund might need to hold 10 to 20% of its portfolio in cash or liquid securities in order to meet potential redemptions. Now, if the liquid portion is earning, say, 5%, while the private portfolio is targeting 15%, that's a 10% return differential on a significant portion of your portfolio. This cash drag will directly impact the fund's ability to deliver the returns that attracted investors in the first place. Because let's face it, money sitting in treasury bill isn't going to generate private equity type returns, right? So it's a trade-off that's inherent in semi-liquid structures, and this needs to be clearly communicated to investors. Now, given these cost structures, what's the minimum AUM needed for a retail private fund to be economically viable? I'd say you're probably looking at around 100 to 200 million, primarily due to the significant fixed costs of the regulatory and operational infrastructure. Break-even points for emerging managers are typically high. And that's because retail private funds have higher operational demands, as we've just discussed. Now, this creates a challenging dynamic for startup and emerging managers. You need scale to be profitable, but achieving that scale in retail distribution requires significant upfront investment in infrastructure and marketing. So it's a kind of chicken and egg situation, right? And I think this is what's driving a lot of managers toward platform partnership, despite the additional fee layer they introduce. These platforms handle much of the heavy lifting: investor onboarding, KYC, AML, transaction processing, tax reporting, basic investor education. But choosing the right partner, stating the obvious here, is very important. You need to ensure your platform partner is aligned with your objective. Otherwise, this can get quite messy to untangle. The economics of these partnerships tend to vary, but usually they involve revenue sharing arrangements where the platform takes a meaningful cut of management fees. But it's a trade-off. You are giving up economics, but in exchange for access to retail distribution channels that you couldn't build on your own, or it would take you years to build that pipework. And so this new landscape is creating a sort of barbell effect for manager viability. At one end, you have the giants, so firms like Blackstone, Apollo, and KKR. They have massive brand recognition. They have all the resources needed to build their own retail infrastructure. And then at the other end, you have highly specialized boutique firms who offer hard-to-access strategies that can command premium fees. But then you have those in the middle, so neither large enough for economies of scale, nor specialized enough for differentiation. They are the ones that I think face the biggest challenge today. I think if you are an emerging manager, the message is very clear. You need a defensible niche and a compelling value proposition, or you need to scale rapidly through strategic partnerships. Now, this brings me to niche market penetration. I think as an emerging manager, you may want to target underserved areas. Another angle, I think, is looking at ESG-linked carry structures. So basically aligning some of your performance fees with specific sustainable development goal outcomes. For example, carbon reduction. I think this can be a powerful magnet for Article 8 or Article 9 investors. And don't forget tax-efficient wrappers. Structuring feeder funds for ISA and SIP compatibility, I think, is absolutely necessary for UK markets, because UK retail investors, they tend to prioritize tax wrappers. You can leverage the FCA's restricted mass market investment categorization for LTAFs. This can also help bypass some of the traditional NMPI marketing restrictions and potentially open up more avenues. But for me, I think the uncertainty in this democratization story is how retail investors will behave, especially during market downturns. Institutional investors, we know they understand the J curve. We know they are patient with illiquidity, and we know they have long investment horizons. But retail investors, I think that's less clear. Retail capital, especially from investors who are saving for retirement, that could actually be stickier than institutional money. When you look at the structures of these funds with lockups, gates, and limited redemption windows, they are designed to enforce long-term thinking. But you also have to think about headline risk and herd behavior. Just look at some of the open-ended real estate funds facing redemption pressures. So, you know, what happens when markets turn south and retail investors who are accustomed to liquidity of private markets, they find that they can't easily exit their private fund investments. I think the reality is we won't really know. We won't really know until these products are tested through a full market cycle. And I think that's where the quality of your initial suitability assessments, your ongoing investor education, and transparent communication can pay off. It's during these periods of market stress. I think managers should not underestimate the complexity of servicing retail investors. They shouldn't try to put this sort of retail veneer to their institutional infrastructure, because that simply doesn't work. You will need purpose-built technology, processes, and teams. And I think as private markets open to retail investors, ensuring that complex illiquid products are being sold only to investors for whom they are appropriate becomes very important, not just a compliance requirement, but potentially a systemic risk issue. In Europe, MiFID II requires comprehensive suitability assessments for LTIFs that are sold to retail investors. So this means gathering detailed information about the client's knowledge and experience, looking at their financial situation, looking at their investment objectives, and their risk tolerance. Now, if the product is deemed unstable, but the investor still wants to proceed anyway, they must provide written consent acknowledging the risks. Now, in the US, FINRA imposes 3 core obligations on broker-dealers. You have reasonable basis suitability. So is this suitable for any investor? You have customer-specific suitability. So is this suitable for this particular investor? And then you have quantitative suitability. So are the number and frequency of transactions appropriate? But systematizing suitability assessments for potentially thousands of retail investors while maintaining quality and compliance is not easy. So I think that's where technology becomes very important. But we have RegTech solutions that are emerging to help automate parts of the process. I think it is very important that managers get the suitability assessment right. If you end up with widespread mis-selling of these, let's face it, complex products, you end up sending these to unsuitable investors. This could very well trigger regulatory backlash and reputational damage to the entire sector. And potentially systemic issues if large numbers of retail investors face losses that they didn't understand, or even worse, they couldn't afford. Now, not all emerging managers have proper compliance framework, and that's also something that should be addressed. LTIFs benefit from passporting rights across all 27 EU member states, and once authorized in one country, they can be marketed throughout the EU. So handling different languages, tax regimes, and local market practices is not easy. Marketing interval or tender offer funds to non-US retail investors will require navigating the securities law, tax treaties, and investor protection regimes of each target jurisdiction. Within the US, funds must also comply with state blue sky laws if they're not listed on a national exchange. Putting aside the regulatory arbitrage, this regulatory fragmentation, I think, increases compliance complexity. We're now seeing some managers establish parallel structures, perhaps an LTIF for European distribution with an interval fund for US investors in order to optimize for different regulatory regimes. Whether we will see regulatory convergence or continued divergence over the longer term, I mean, who knows? But I think the SEC's recent liberalization suggests some movement toward the European model of purpose-built retail structures. If you're looking to tap into this retail private markets revolution, here's what you need to think about. Choose the right structure. Your choice of fund vehicle and jurisdiction is absolutely fundamental. If you want to target UK investors, then you can look at LTAF for retail and pension access. If you want to target European investors, then you can think about an LTIF or a CCAV, Luxembourg CCAV, which allows AIFMD passporting. If you want to target US investors, you're probably looking at a Delaware LP or an interval fund for accredited retail. Now, if you want to explore other offshore options, you can look at Guernsey authorized or registered fund, or you could also look at a Jersey expert or unclassified fund. You can think about a Cayman or Luxembourg master fund for global efficiency. But I would say don't just default to what's familiar. You should analyze based on your target investor, your strategy, and critically, your cost constraints. And secondly, I would say you should master liquidity engineering. This is not optional. You will need robust frameworks, you will need innovative buffer strategies, and you need transparent disclosures. These are key. This goes back to what I said about making sure your liquidity disclosures are watertight. And then thirdly, I think you need to build for retail scale. Your technology, your operations, and your compliance, they must be purpose-built for high volume, high-touch retail. You should seriously consider white label solutions to manage those initial costs and get to market faster. And then fourthly, I think you need to be strategic with distribution. You should think about how you can diversify your channels. You need to look at cost-efficient partnerships, like, for example, robo-advisors, but you need to make sure that you understand the specific economics, like, for example, the tiered revenue share models that I touched on earlier. And then fifth, I think you should think about costs and you should think about niches. Be realistic about your higher total expense ratios. These come with the territory that's common with retail funds. You need to think about how you're going to differentiate yourself. And I think the way to do that is think about niche strategies. Some of them we talked about earlier. And finally, governance. You need robust compliance. You need independent net oversight and a deeply embedded culture of investor protection. These are non-negotiable. I really believe that these are the bedrock for a successful retail offering. Now, to conclude, by 2030, if projections hold, retail investors could represent a multi-trillion-dollar force in private markets. We'll likely see continued innovation in fund structures, potentially including more hybrid models that perhaps blur the lines between traditional closed-ended and open-ended funds. I also think that technology will continue to play a transformative role. And I think AI will maybe revolutionize how suitability assessments are conducted and how investor education is delivered. I also think that blockchain will enable more efficient operations. And I think that we could even see tokenization of private fund interests, perhaps a topic for future episode. In terms of regulatory scrutiny, I think that will intensify as retail participation grows. And I think that the first major market downturn that significantly impacts retail investors in private funds will be a crucial test of the democratization thesis. Now, how regulators, managers, and investors respond will shape the trajectory of the market for years to come. We're also likely to see evolution in fund terms and in fee structures, most certainly fee compression. And as retail capital becomes more important, I think its preferences for transparency, for simplicity and alignment will likely influence how all private funds are structured, not just those explicitly targeting retail. To conclude, I think the democratization of private market is not just about lowering the minimums. I think it's reimagining how alternative investments are packaged, how they are distributed, and how they are managed. For retail investors, this offers unprecedented access to asset classes that can enhance returns and diversification. For managers, I think it unlocks vastly new pools of capital, but I think this will require new capabilities and infrastructure. And then I think regulators will need to grapple with what this means for systemic risk and for market stability. I think we're still in the early innings of this transformation. Regulatory frameworks are new, the operational models are still evolving, and investor patterns are still being established. But one thing is clear. I think the walls between institutional and retail investing are coming down. I think managers should spend time to understand the needs of this new investor base and the need to build trust through transparency, through education, and through alignment of interests. Thank you for listening to this debut episode. I hope you've enjoyed it as much as I have recording this. It's been great fun. If you have any comments, questions, or even suggestions for new episodes, then drop me a line at asad.bukhory@artisangovernance.com. That's asad.bukhory@artisangovernance.com. I would greatly appreciate if you could share this episode with your network. I'll be back next week with another fresh perspective. Until then, stay compliant.